Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. On the line with us today is returning guest and publisher of Doug Casey's International Speculator, Louis James. Louis, welcome back to the program.
Glad to be here.
We had dinner here in Condado last week, a neighborhood in San Juan where we now both reside, and at dinner we discussed mutual passion being the mining sector, junior mining to be specific. And before jumping into our talking points of today, you always have a fun travel schedule. Where are the last couple interesting projects you've had the pleasure of visiting?
I was just in Kosovo, of all places, and that turned out to be really quite interesting and maybe not as scary as the headlines might have you think, for a recently war-torn region. It's funny, in places like that, Colombia when it came out of the war, Serbia when it came out of the war, for all the history and violence and so on, people tend to get very pragmatic. They're tired of war. They want to work. They want jobs. They want to go ahead. And that can actually be a surprisingly positive investment environment.
Interesting. Also, before we get into the main topic of today, Louis, there's a bit of interesting action in the markets. I don't know if you're paying attention to the day today, but the gold stocks have really sold off quite a bit. The HUI is down from 200 to 190 today. It's Tuesday, April 25th, and the Dow Jones is up 250 points. So really the worst situation for a gold stock investor.
I said the NASDAQ broke 6,000. That was a big psychological hurdle or ceiling to break through. Happy, happy, joy, joy. What's really striking to me about this, and of course markets are complex, they're not one thing. Mr. Market isn't a person with one mind. But one of the things that it's very evident to me is as soon as trading opened in gold overnight, it was after the French election, and that okay, I get that it's good news that the former banker, seemingly more sane candidate came out ahead in France and might avoid the breakup of the EU. But being the front runner is not the same as winning. And I think the people from the Hillary Clinton campaign could tell you a little bit about making many assumptions on that account. So the market is reacting as though the supposedly Trump-like candidate is defeated in France, whereas in fact she's gone on to the final round and is, I think, a more clear and present danger if you're a pro-EU person than before. And yes, the parties that don't like her, we're going to rally around. They'll throw their support behind the more centrist candidate. Even opponents will join their banners behind that flag. But still, Trump spoke to the hearts of many people, and I think Le Pen will too. And the shooting of the police in Paris just before the election had a substantial impact, and things keep going there. We're getting off the topic a little bit, but I just think this is actually really interesting you bring it up because I see this as a clear opportunity. When markets react to something as though it was a certainty, when it's not, when it's a question mark, but they act like they know what's going to happen, that's when contrarians can really, sharpen their pencils and get to work and do some good research and come out ahead, I think.
Sure, and we've already had Brexit. You mentioned the Trump election, so we could have a third thing that happens in a short period of time that spooks the market. I think what keeps me at ease right now as a gold investor is, whereas before January 2016 we were clearly in a very bad bear market, we're now in a bull market, and so even days like this, you look at just what's happened over the last 16 months and you say, okay, it's hard to break this trend and things are still going in the right direction. Do you feel that way?
Yes, I think it's always 2 steps forward, 1 step back. My projection is for fluctuations, but higher highs and lower lows as we go forward. I think we did turn the corner at the bottom in late 2015. It's onward and upward from here. And the proof will be in the pudding. When gold takes out 1,400, I think that's when a lot of the skeptics will be quiet. We got to the high 1,300s last year. So just getting back over 1,300 now, that's nice, but it's not going to do it. I think we need to take out 1,400, and then I think a lot of the bears will be a lot quieter.
Well, the main reason that we're having you on the show today is to discuss what you told me was kind of a eureka moment for you last year when you came on the point of what you're now calling the golden runway, which is essentially an investment thesis that you've come up with. And I found what you told me in the car last week to be astounding. And that's essentially that there's huge and safer gains to be made in exploiting a very specific part of that junior explorer life cycle. And I'm going to have our editor put that up on the screen. Everybody's seen this before. Louis, tell us what this life cycle represents.
Yeah, it's an amazing thing. Let me preface this by framing it a little bit. In many ways, I love my work. Don't get me wrong. I love what I do, and I'm good at it, actually. So, joy, joy. But I stand on the shoulders of giants, right? I learned from Doug Casey all the tricks of the trade, and I've been following the Casey method, as it were, for many years. And I research and make recommendations about explorers out there who are doing, real boots on the ground exploration and making discoveries, original discoveries of their own. How exciting that is. And I'm kind of a reporter, a little bit more than a reporter. I'm an analyst, and I try to separate the wheat from the chaff. I think of it as a treasure hunt within a treasure hunt. They are literally looking for treasure, and I'm trying to look for treasure on the stock exchange, the ones that really have the goods. But I don't often get a chance to create. So I've actually made my own discovery, and I'm really excited about it. The joy of making my own discovery is really the smaller thing, though. The thing, though, is that investments in resources are always risky. The name of my major publication is the International Speculator, not the International Safe Investor. So to find some little corner of this market sector where there are really large gains to be had in a relatively safe bet is astounding. I mean, it's sort of like saying that black is white, safe speculation. There shouldn't be such a thing. And that's what my research is finding, though, that there is a corner of the market. I call it the golden runway, as it's like the companies go on the runway up towards production. And it's known for a long time. Something Doug taught me is that there's always a re-rating as companies become producers, as they go from exploration to production, and stocks tend to go up. But the assumption has always been that that's kind of baked in the cake, as it were. It's priced in. Everybody knows that's coming. So the gains, there are gains as you approach production, but it's not so great. That's why we like exploration. We like discoveries. That's where 10-baggers can be found. When a company has nothing and it goes to making a world-class discovery, the stock goes through the roof. And that's great, and I still love the discovery cycle. Don't get me wrong. That's what we see in that chart that you're putting up there with the initial exploration phase and your 10-baggers when a company makes a discovery, and then we go into the boring engineering phase where they have to figure out whether this discovery will be economic, and they make a production decision. And then as the company approaches production, the stock begins to rise again, and it's a question mark what happens there. A mine, of course, is a depleting asset. If all you have is one mine and you put it into production, every year there's less gold or whatever left. So you need to make new discoveries and grow. And this is what my elders, as it were, taught me in Mining 101, Investment 101, and I never really questioned it until late last year. I said, well, what is the gain from the construction decision to that first pour of gold or whatever metal you're producing? And nobody I asked knew the answer. Nobody could tell me what it was. So I started looking. And at first, I collected a sample of stories. I knew a couple dozen, and the numbers just blew me away. I couldn't believe them. I said, wait, this can't be right. So I got my research team, and we went and we found just shy of 50 companies, 49 companies, and we looked over the results, and they're unbelievable. And I'll tell you in a minute what they are. But so we still were skeptical, though. And we went back and we scoured the books and we went to the Northern Miner and looked in their archives for every example we could find of an explorer. It can't be an existing producer building another mine. It has to be an explorer making that transition from exploration to production on their first mine. And what we found, we now have a sample size of 100. I'm not rounding it. It just works out that that's how many we found at the moment. And we found that out of these 100 first-time mine builders, 92 of them actually succeeded in building their mines themselves. That's a 92% success rate at building the mine. Now, maybe that seems like a no-brainer. Nobody's going to start building a mine unless they think they can do it. No bank's going to lend them the money unless they think they can do it. But failure is still possible. And by the way, 92% could be the low end, because 3 of the companies were taken over, and the mines later completed by the buyers. So if you and those takeovers were at a positive premium for shareholders. So if you count those as successes, the success rate at building a mine is 95%. This is a very high success rate. That means in this small subsector of the metals and mining market, you know that 95% of the time, if you get to that construction decision, you will succeed and get to the end goal of value added through the construction of a mine. This is very significant. Not surprising maybe yet, but significant. Keep that in mind. So then we say, okay, so what's the average gain of these companies? And that's where the real surprise came. And the numbers that I couldn't believe and now have survived 3 efforts at digging in deeper and finding more research on this. The average gain of these successful mine builders was 101%. They doubled from the construction decision to the first pour. Now, 101%, a double, is something that we think of as a successful speculation, not something that you can get 92 to 95% of the time. That's the power of what I'm talking about. It's unbelievable to me that something so predictable can return such a high gain. Now, of course, they didn't all double. Out of the entire sample, only 73 of them actually ended up in the black. That means 17 of them ended up in the red. So it's not a guaranteed thing. Not all of these companies will deliver. But again, the average from all of them was 101%. If we looked at, that's all the ones that succeeded. If we look and include the failures in there, the average is still astounding. If you bet on all 100 of those companies that we found, and this data goes back to the 80s now, 1980s, it's a pretty wide and long data set. The average is still 91%. It's still almost a double, including the failures. So this really set me back. Again, I'm the international speculator, not the international safe investor. I'm gobsmacked that such gains can be had on something so predictable. But that's not it. That's not the end of the story. Of course, the 73 that did succeed in the black, that ended in the black, their average gain was 136%, so that's better. I can also say, though, and here's the real kicker for me, is that if we look at the highest performing companies in this space, the ones that deliver the best from construction decision to first pour, their average gain was 700%. It's actually 699.97. But basically 700%. It's not quite a 10-bagger, but it's pretty darn close for something that is so predictable. The problem with your typical exploration stage 10-bagger shot is that nobody knows who's going to make a discovery. Even the best explorers in the world, people who've done it multiple times, they can search for years and not find anything. There's no guarantee for exploration success. The best you can do is mitigate the risk with the prospect generator model and that sort of thing. So here we have something that's highly predictable, and in the best cases, it can yield something on the order of a discovery. I mean, 700% gains is not too shabby.
Well, yeah, I was going to say your research, Louis, indicates, as you just said, that since 1980, 100 companies that you've looked at in your data set have made the decision to go into production. 92 of them made it. And jokingly, I find that data must be a little bit skewed. I'm just trying to find out what the filter for a company, quote, saying they will go into production, because I've heard probably 100 CEOs since the beginning of this year make some claim that they were moving towards production. So what's your filter look like for that?
Yeah, it's a very good question. And of course, you can't just filter for developers. So-called developers are beyond the exploration phase and going towards production. That's what development means. And you have a lot of companies with developer in the name, but they're not developing anything. They're still just exploring. So we looked at press releases saying the board has given a green light to construction of this project. And if we couldn't find that, we looked for, we have started pouring foundations or earthworks for construction, something that was solid, a tangible press released event that says this mine is being built. And if we couldn't find that, it didn't count. It didn't rate for the survey. And you bring up another interesting angle of this too, is that we could be only seeing the successes, because if you fail, company goes out of business, you can't find the website, you can't find the news. How do we know that the results aren't biased towards success? And I suspect that if there is any bias in this research, it is that is biased towards success. But what I can say, though, is that we didn't just look for successes. We didn't just look for companies that had built their mines. We went back and we looked, as I say, in the archives of the Northern Miner, we looked for all these construction decisions, whether they finished or not. And we did find, there were as we say, it was 92% success rate at building. That means we found 8 cases where the company didn't build it. Though, of course, 3 of those, the mine was built by somebody else who took the company over. So at the very least, I can say we weren't trying to look for the best possible companies, and we put effort into finding all companies, whether they succeeded or not. And this is what the data says right now. Now, will further research change it? Probably. But we've gone through 3 rounds of research, and the numbers come out similar every time. And how many companies have actually done this, Colin? Do you think? How many companies do you hear of building their first mine every year? It's, you can count them on one hand. So the fact that we have a sample of 100, I don't know what the total number of companies that have built mines for the first time in the last 30 years is, but 100 is a pretty large chunk of them. So I think it's statistically a very robust finding.
There's an old adage in the space that a rising tide lifts all boats, and conversely a falling tide lowers all boats, which I would certainly say for the class of stocks I'm investing in, being explorers, is true. What happens in your data when the price of gold is falling or the gold equities are in decline?
That was Doug Casey's first question when I told him about this. And he was also shaking his head. And that was his first thing was, people tend to build mines when the markets are rising and bull markets, everything goes up. And I said, that's true, but we looked at that. And out of our sample of 100, we found 30 companies that built their mines during bear markets or largely in bear markets. So, sometimes they would have started building and then finished at the beginning of the next bull market, or they would have started in a bull market and then it turned bearish and they finished in the bearish market. And some of them were built entirely during bear markets. So they still built their mines. And the average gain for those 30 bear market builders was 27%. Now, that's drastically less than 101%, or certainly 700%, but it's still positive. So this is, again, really striking because there's so much risk in investing and speculating on exploration and resource stocks in general. Even the majors are so volatile that standard Graham-Dodd type analysis just doesn't apply, even to the likes of Barrick and Rio Tinto and so on. So if you find an investment strategy that works even in a bear market and returns on average positive gains, okay, modest gains, 27%. And by the way, the average time for construction is a little bit less than 2 years. So a 27% gain in 2 years, that averages out to much better than money left in the bank. And this is in what is normally thought of as the most volatile stocks on earth, as Doug likes to call them, a high-risk sector. So I'm finding this really, really striking. It's the key point here is that nobody builds a mine unless they're pretty damn sure they can do it and it's going to make money. And nobody lends them money to do it, and no investors will step in with the hundreds of millions of dollars usually needed to do something like this unless they're pretty darn sure it's going to work too. So the whole question we're looking at is a small space where the probability of getting from point A to point B, from construction decision to first pour, is very high. And the average gain, the average market response to that in bull market or bear market is positive, and sometimes extremely positive. So it gives us a much lower risk way to go about pursuing substantial gains. And of course, if you're bullish on the markets, as I know you and I both are now, we're not too worried about what happens in a bear market. We're looking for the juicier end of the spectrum, as it were.
Further to your point, if somebody has enough money to build a mine, it means somebody's probably loaned it to them, and they're not going to start construction unless they're fully funded. I want to ask you about the mine after it's built, meaning looking at the net present values or cash flows that come from those mines. Is the market properly anticipating during that construction phase how profitable the mine's going to be? Does that have any indication on your data?
Yes, it's another excellent question. It's quite interesting to me to look at how these things go. You watch these charts, and there is a dramatic acceleration during the last few months before production. From the construction decision, it starts sort of slowly, and then it gains momentum. It's a distinct curve upwards within the last 9 to 10 months before the first pour is achieved. So there's that. And then after first pour, now that's really interesting. There's often a retreat after the first pour. And it takes time. Once you build the mine and you pour your first bar of gold and it comes out of the furnace, and it's hot and it's glowing, and it's like this warm little baby, this bundle of joy you hold. If you've ever been present for a pouring of gold at a mine, it's quite an extraordinary experience. Very exciting. But then after that, reality sets in. And now we've got to worry about whether this mine actually makes money. And now you're a producer, and the market looks at a producer very differently. And it's not about can we grow this or what's exciting and in milestones. It's all about the bottom line. And so you'll often see that the shares will retreat after first pour. And even when they don't retreat, they struggle to gain ground afterwards. We looked at our sample, and we looked forward from the first pour to the next year afterwards. And the average gain after that was only 17%. So yes, if you hold on after the first pour, there can be gains, and obviously not all the companies were the same. But on average, most of the excitement, most of the joy is built up into that moment where you go into production, and after that, the hard work begins.
Well, let's move towards the logical conclusion of this discussion, which I'm sure is where you're focusing much of your research attention on now, and that is within these 100 companies since 1980, identifying the factors which are identifiable that make a stock end up on one side of that curve and not the other. How do you get into those 600 or 700% winners as opposed to the 40 or 50%? There's a whole bunch of different factors you could look at. So what are you guys looking at?
Right. Well, you're kind of asking for the secret ingredient here. We are indeed researching this. It's the main focus of my entire team right now, is to hone in on those factors that can help us predict which will be the 700% type winners. And we have found some, and I'll tell you that it's not anything that you might predict. It's not grade. For example, one of the spectacular successes of a stock going vertical up to first pour was Silvercorp, which was super high grade, the Ying mine in China. But another one like that was Copper Mountain, which is a low-grade bulk tonnage copper project in British Columbia. So it wasn't grade. It wasn't political risk, by the way. You could look at those same two examples. British Columbia, a first world jurisdiction, Canada, very mine-friendly, can't get much safer than that. And the Ying mine was in China. So the higher risk of unknown mining infrastructure and legal structures in China at the time didn't hold Silvercorp back from a high gain. So it's also not the metrics that you might assume. It's not net present value. It's not internal rate of return. These things don't correlate at all with success on the high end of the spectrum. And in some cases, it's somewhat negative. So exactly what we're doing, I'm not going to give away our secrets. I'm sharing my research with this idea. The investment thesis, I think, is sound, and I'm happy to share it. But obviously, we want to hold back that little secret ingredient for the benefit of our subscribers. But I will say that I think the people factor is key here. It's really interesting. Of Doug Casey's famous 9 Ps, used to be 8, now it's 9. The 9 Ps of resource investment, the people is the first P. And the best rocks in the world can be messed up by the wrong people. And having the right people to do the job is important. But related to that is promotion, which is another one of the Ps. And the right people can sell the story. And the right people can get the institutions involved. And in fact, we do see that. There's a correlation between the higher end winners in this little slice of the market and getting more institutions involved as they approach first pour. And it takes the right people to do that. So, who are the right people? How does it work? What are the various factors? We're going all this over together right now. We're actually working on a scoring type system, and we're hopeful that our scoring system will help us predict the next round of 700% winners.
Louis, congratulations on this amazing find. I'm really interested to see what else you find out. I'm a subscriber to the International Speculator, and I think it's one of the best newsletters going. If you want to find out more information, you can, of course, go to caseyresearch.com. Louis, if you have anything else to add to the audience, anything on market conditions or your newsletter, have at it.
Well, I just want to encourage everybody, now's the time. I do believe the market has turned. There are mines building. It's still not too late to get in pretty near the ground floor. Doug Casey and I are both convinced that we're in for a major bull run. It's going to put 2011 to shame. So I want to encourage folks to get involved. If you're hesitant, then I'd ask you to check back on us in a year. We should have a conversation 1 year from now, Colin, and say, okay, so there was your research. You invested based on that premise. What are the results? I think we'll have some great stories to tell and share at that time.
Absolutely. Louis, thank you for coming on the program.
Thank you for having me, Colin.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?